So looking at decarbonization strategies from the issuers in our coverage at Alliance Bernstein, just to step back and give a bit of context. At Alliance Bernstein, we manage around 300 billion of fixed income money, a meaningful proportion of which is in the corporate space. And we integrate ESG across our platform. And that means that our analysts have to score each of the credits they cover on E, S, and G. And within E, considerations around transition and carbon risks are obviously very important. And we see those as material financial risks in many industries. Thinking about decarbonization pathway, our preferred path is to for an entity to decarbonize their own operation, really to try and mitigate the transition risks that they are exposed to. So we would like to see organic disposal. If you think about utility, for example, decommissioning of these dirty operations in favor of investing capex into new, cleaner forms of energy. Because we believe that as the world transitions, demand for these lower quality assets from an E perspective is going to reduce over time. And so it is very important for us for these issuers to think about decommissioning and organically decarbonizing their operations as opposed to just disposing of assets. Thinking about the sustainability and impact piece, we have a strong preference for decommissioning for and green capex as opposed to asset disposal for obvious reasons. When companies dispose of these assets, they usually go into private hands. It's harder for us to engage and to enact impact in this space. And then thinking about carbon offsetting, it is something that we would consider with a lot of caveats and a lot of due diligence, but we would like it to be the last piece in an issuer's decarbonization journey.
What we'd like to see, though, in terms of the transition plan is a clear articulation of, how that is going to be achieved. So that includes obviously not just the long-term targets, but shorter-term and medium-term targets. Again, clarity on the scope for which that decarbonisation target is being set. In particular, I think depending on the sector, consideration not just of the operational emissions, but also the product-related emissions or upstream emissions as well. So this point around the scope 3 emissions is important. As Leon said, the issues around capex are really important because as a company reorientates and refinances internally to align with that strategy, we want to understand and get comfort that is being supported by internal capex decision making. As well. I think likewise, where there is that sort of diversification of product or where there's reliance on innovation, again, these are all elements of the transition, that transition plan that we would like to see. I think as a framework, this, TCFD is obviously a key one already, and increasingly being rolled out across different regulatory jurisdictions in terms of disclosure. We see the transition plan as fitting clearly, within that because we want to understand what that strategy is.
Green tech is a fairly broad term, and to me anyway, it covers two aspects. The first is, as you suggest, it's a complement to the nature-based voluntary carbon credit market that actually removes CO2 from the atmosphere. And once again, we're not going to be able to reach those goals without that tech solution. There just isn't enough land, and we can't plant enough trees to remove the amount of CO2 that we need to. So those tech-based solutions like DACs and BECS are vital to reaching those goals. And on the other side, so I guess green tech avoidance, if you like, how can tech help us with substitutes to the current sort of fossil fuel solution Things like green concrete. If tech can provide those kinds of solutions, so to replace the current methodologies that we use in our carbonized world by substituting a decarbonized solution, that's really going to be vital in terms of the long-lived solution of the decarbonized economy. And once again, without them, we're not going to get to that point where we've created that new decarbonized economy. So both aspects, the removal aspect and that sort of substitute avoidance aspect that tech brings, it's vital. And we're seeing a lot of people who really agree with that and are doing a lot of investing in that area.
We are also sensitive to what our end clients ask from us, and there's definitely this very clear consensus from our end clients that gas and nuclear, should they be included in the EU taxonomy, for any alignment reporting that we would have to do, we would have to break those out. So I think it's pretty consensus across the investor community and across the end asset owner community that we may want to use them as a transition fuel, as in terms of within the next 10 years or so, but long term this is not a sustainable fuel mix to have for a 2050 vision.
So when we speak about voluntary carbon markets, they essentially operate on the principle of offsetting. So the reduction in greenhouse gas emissions from one place can be used to offset the emissions taking place elsewhere. So a company in that regard may purchase carbon offsets to address its direct and indirect greenhouse gas emissions. And in this context, obviously, one carbon offset represents 1 ton of carbon dioxide emissions that has been avoided or removed. So from BlackRock's perspective, we see these offsets as a complement to and not a replacement for companies' sustained and substantive long-term emission reduction plans. So we believe that voluntary carbon credits and markets should be used as a supplement to science-based emission reduction efforts on the path to net zero. So these carbon markets and instruments should not replace or disincentivize efforts to rigorously reduce emissions. But that said, we do support companies' decisions to invest in technologies and solutions beyond their operational emission reduction goals. So where they do end up using carbon offsets, nature-based solutions, and so on, we find that disclosures detailing how these projects or offsets are evaluated and assessed for aspects like their permanence, additionality, leakage, as well as double counting would be beneficial. So, because this would assure investors that such investments are indeed achieving their stated purpose. In terms of how we view these offsets, as you're probably aware, the US Securities Exchange Commission voted in the landmark proposal yesterday, requiring publicly listed companies to include climate-related disclosures in their registration statements and periodic reports to the Commission. So this includes climate-related risks, transition plans, Scope 1 and Scope 2, as well as material Scope 3 emissions. And many of the requirements proposed are actually included in the TCFD framework. So as mentioned earlier, you can see that there's a lot of these regulations that are building off of the TCFD framework. But some aspects of the SEC proposal are more prescriptive, and in the context of carbon offsets, for instance, if a company has been using carbon offsets as part of their climate-related targets or goals, they would be required to disclose information such as the role that these offsets play in the company's climate strategy, the amount of carbon reduction represented by the offsets, as well as the short and long-term costs and risks associated with purchasing these offsets. So, including the risk that the availability or value of the offsets might be curtailed or may increase by regulation or changes in the market. So the level of nuance that even mandatory disclosures are kind of tending towards requiring in terms of how companies use carbon offsets, kind of it shows alignment with the investor perspective that definitely we don't think it acceptable if you're solely relying on carbon offsets to kind of achieve your decarbonization goals, but it can definitely serve as a complement, and that there's a lot more thinking that needs to go into actually fleshing this out as part of the overall climate strategy.
To understand where they fit in the overall strategy, and I think the point about that they are part of that toolkit and sort of the last tranche of that, I think, is important. I think we also need to think about the credibility of using offsets as well. And I think one of the challenges when you're talking about very very high emitters is actually is there going to be the availability of credible offsets in the future? And I think it's really important that's part of the scrutiny and then the disclosure from corporates in terms of what we're looking for. Obviously, but ensuring that they're verifiable, that they're appropriately accounted for, that we have the longevity, etc. I think also the move from the sort of offset avoided emissions to the removal. And we touched briefly earlier on the point that there's a whole. You look at any of the IPCC net zero trajectories; they all have the bit below the line. That's where we do need to remove. But we also know that's not there at scale yet at all. But I think that's a really important point to make, is that what carbon offsets look like needs to move towards the removal offsets and the permanent and long-lived, and seeing this again as a permanent piece of removing carbon from the atmosphere. Now, obviously, how quickly that piece of the technology, and then the piece of that, the market, the generation of those credits. And again, I think, this is one of the challenges that is, constantly put against any transition plan, really, is that tranche of the bit that we don't yet know how to solve.
We see carbon offsets as one piece of the puzzle. We don't see it as the be-all and end-all. There are issues not only around permanence and additionality, but also the price that these corporates are paying for the offsets. Most voluntary carbon markets trade at a price that is well below what is needed to achieve net zero by a magnitude of 10x, probably. So that's something that we need to be cognizant of. In terms of what we look at, we do favor removal solution in the non-nature-based space. Within the nature-based space, we think there should be space for avoidance offsets. And actually, when you dig into the detail, a lot of these removal nature-based offsets are pretty terrible from benefits perspective, or like co-effects on biodiversity and so forth. In terms of certification regimes, we are cognizant that 80% of the market is coalescing around Verra, and that's okay. Some of the standards put around Verra are pretty interesting. However, we have done a lot of work to try and understand exactly what is the makeup of the market and what does a Verra certification means. And there is a degree of variability even within Verra offsets more broadly around offsetting strategy. What we are increasingly questioning our investee companies on is what vintages are they using for these offsets, just thinking about the additionality value. We are asking them about the average price. And what we have found also, we did a deep dive into this market and opened a can of worms for ourselves, and in some ways finding out that some companies use a certain type of offsets for their scope 1 and 2 emissions because they know they're going to get investor scrutiny, but perhaps use lower price, lower quality offsets to offset their scope 3. And we have also unearthed practices such as repoing of offsets at the end of the year to have them off the balance sheet and having all vintages being retired on a year-by-year basis. So we have done a lot of forensic work to understand what is going on in this market and increasingly scrutinizing our investee company through that lens.
Been good to look at the innovation around the sustainability linked bonds and also sort of transition bonds as well. But I think one of the challenges around the construct is really, what is that? Are the incentives right? Are the targets sufficiently ambitious? Is it right that in terms of how the payout works, whether they meet or don't meet the various targets? So I think there is a question there around whether we quite have the right structure for some of those sustainability linked bonds. That's not to say there aren't some great projects that are financed through that. One of the things that leads me to say that is because I think, increasingly these, all companies, or certainly all corporates for which, it is a material issue, and frankly, that will be all corporates, is the extent to which that should be core to the strategy in any case, and therefore actually, general purpose bonds should be delivering, or should certainly the impact and the progress of a company's decarbonisation strategy should become increasingly apparent and better reported to investors. And I think, if you look at something like certainly within Europe, the taxonomy reporting regulation, the improvement in the corporate disclosure framework, I think may lead to that as well. So I guess the thing is that there is certainly, I think it's an interesting, I suppose, structure for financing. I think there has been and will increasingly be a lot of scrutiny on how those targets are set. And, as with all, green, sustainable, social, sustainability linked bonds, the reporting piece is really key. And that's also where we're, the issues around additionality, permanence are increasingly creeping into the expectations of what that reporting looks like as well. The use of proceeds construct of green bonds is incredibly important and key to, I think, increasingly investors seeing the role of green bonds or sustainability bonds in terms of their portfolio decarbonisation. However, as with most frameworks, it's all about the detail. Obviously some of them are new projects rather than refinancing. When we evaluate green bonds, our sort of green bond assessment framework also looks at the issuer. Not just from a sort of ESG risk perspective, but strategically, where do green bond issuance fit into its decarbonisation plans? And I think, that context, actually, financial institutions are, very interesting. I think, banks can play and will play a massive role, but actually how they use green bonds in that, I think, will be interesting. But again, what is the quality of the impact data being reported? Are those reports are those impacts verified? Ensuring that, again, that sort of full transparency of where the use of proceeds is going and the impact that is having is followed through. So I think we have seen some investors, not a lot, who have a specific allocation to green bonds, but I think increasingly investors who are looking at how do you decarbonize your overall portfolio. Obviously, one is around the decarbonisation trajectory of those corporate shares, bonds in your existing portfolios, but it's also about how do you gain exposure to some of those investments that are actually delivering some of the the benefits, the investment that we know we need to enable a sort of decarbonisation to a lower carbon economy. So that, I think, that's where there's a really interesting space for green bonds. But again, the importance of transparency, robustness of the framework and the reporting is really critical.
We have developed a framework for sustainability linked bonds, and those include considerations about the structure of the KPI from a bond perspective, but also the nature of the KPI. And within nature, the KPI, we look at materiality, ambition, and benchmarkability. And where the piece around carbon offsets sits is really around ambition. As I mentioned before, we don't think an SLB including carbon offsets is ambitious enough. And all the SLBs that we have invested in, we have made sure that the KPI does not allow a company to use carbon offsets versus operations decarbonization or scope 3 decarbonization to achieve their target. So I guess the short question the short answer to your question is we want to make sure companies are held to account to decarbonize their own organically their operation, as opposed to relying on carbon offsets when entering these SLBs.
At the moment, it's very much, disclose how you're planning on doing that. I suspect, as with other, expectations around what good, climate risk management framework looks like, or the disclosures that illustrate a climate risk management framework, we will. There will be increasing expectations, and therefore, I suspect, given the challenges we've already outlined in terms of carbon credits, I think there should be an expectation that some investors may take a much harsher view on that than they may currently. But again, I think this is really goes back to the point about is that transition plan or decarbonisation plan credible? And obviously, as we now go into the year-on-year measurement, are we actually seeing that decarbonisation? I think there's been a lot of focus on the plans and on the targets, but we're looking year-on-year on our own portfolios. We're looking not just at the intensity, but at the absolute emissions from companies in our portfolios. So from that context, it's absolutely about the operational or product related emissions reductions, not just being able to offset those.